This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd and you're watching Talk Your Book, and today we're joined by Jun Bei Liu from Tribeca Investment Partners. Jun Bei, thanks very much for coming back on the show.
Thank you very much for having me, Chris. It's always great to chat.
Now, I thought before we get into your stock pick of choice, if we could start with Tribeca Investment Partners, and I know you run a long-short strategy there, but how do you guys look to invest and how are you finding these markets?
Look, so I run the long-short fund for Tribeca, and what we aim to do is that we buy the company we love. Don't do a lot of research about it. We buy the company we love, and then we short the companies where we think the share price will fall. As the name suggests, that we benefit from rising share prices as well as falling share prices. So the current market condition actually works fantastic for our fund, simply because we not only benefiting from low and falling. We can actually use that to buy any company we like, even when market sentiment is against it. Take it for example, early this year, healthcare names were sold off in a big way because they were too expensive. But easy way for us to do is that we can jump in and buy when most managers couldn't, and then we can short other expensive companies against it. And in return, we have generated a very big return very quickly. And same goes for many sectors. So we don't, during market volatile times, many managers worry about portfolio become too risky and everything. We always remain neutral, and then we can buy things whenever we need to. The current market condition is fantastic.
And what stock did you want to talk about today?
We'll talk about this one. It's very interesting. It's really lagged many other businesses, especially this reopening theme sort of businesses. And one of the very few companies that haven't seen the share price going through the roof. That is Ramsay Healthcare. This company, we probably all know the name. It is to provide the premium private hospital service around Australia, largest player, and also many years ago it bought into UK, has good exposure there, and as well as push part of the French private hospital business. Now this business for many years have grown the companies or grow its earning consistently, simply because private hospital elective surgery is it's very defensive growth, and then as people getting older and things, there's a lot of elective surgery volume continue to grow in the sort of mid-single digit, and then the pricing continue to grow. So this company used to deliver high single-digit growth, excluding acquisition, year in and year out. Now, the opportunity came when obviously COVID took place, and the people couldn't go to elective surgery. All the hospital beds was needed to be open for potential COVID-related illness, and so the earnings for this business was impacted enormously. Pretty much went to zero. Ramsay at the time actually stepped up and helped the community, gave out a lot of their medicine and things to help out the community on COVID, and that was great big tick for them. But clearly business went through a very tough time, and finally in the last 6 months, and we beginning to see some of the green shoots. But Australia, if you remember, we were still in lockdown 6 months ago, so it's just taking time for the surgery volume to recover, as people started moving out and about and decide to move on with the surgery they need to do. Now, one good indicator of where the earning is going, or lead indicator, is the public hospital waiting list. Now, this used to be less than 6 months, and more recently it has gone through the roof. It is now over 2 years, in some cases close to 3 years sort of waiting experience. Now, these are the waiting list and lead indicator for where the patients will be for the Ramsay hospitals, and we know the earning will be incredibly strong over the next few years. So this company represents fantastic value for us, with the volumes recovering, going to deliver double digits earnings growth, with or without economic activity improving or stay at a certain level. we all heard quite a lot of people worry about, are we heading recession? Are we going to this? Are we going to be stable? Guess what? For this company, for this investment, you don't really require the economic activity to stay at where it is. It is very defensive earning. It's private hospital, and the volume is going to recover from the very, very low level that it experienced previously. And so all of that together, company going to grow, defensive earnings. Now the balance sheet is a little bit different. We'll touch on that later. But and the company, if you listen to all these characteristics, you'll be thinking it must be so expensive, but it's not. The company actually was just being bid for by private equity a few months ago, because the small differential in pricing, plus there's a bit of at the moment bit of indigestion in the merger acquisition market for the temporary investment banking loan, that has caused the private equity player to step away. And the share price, the bid price was $88. The share price now less than 55. And this company was trading on $72 before even private equity came into bid for them. So if you look at this valuation, the company is incredibly full of intrinsic value at this point. A lot of assets sitting on the balance sheet, not yet revalued. They sort of carry at this historical value, and then with a business that's just incredibly defensive and in a really, really good structurally growth spots.
So let's dig into a few of those things. Maybe let's start with the KKR-led consortium that tried to buy it recently and have walked away. Do you see them gone for good, or could you see a world where they come back in 6 to 12 months if capital markets settle down a bit from here?
Yeah, look, I do see someone will come back, whether it's them or whether it's in different form. KKR has done work has done work with Ramsay for the last 3 years. And then finally, when they launched the bid, they have know a lot about the business, and they're very keen to bring it on board. Now, at the end, how it walked away, I do need to talk a little bit about, capital market dislocation at this point, is that, in the US market in September, you probably remember that the bond yield started becoming very volatile. Because people worry about inflation and recession and suddenly everything else. Bond yield jumped significantly, which means the debt has become more and more significantly more expensive. Now, in the US market, the investment banks, they normally work with companies to do M&A deals, and they take those debts, they provide them with a short-term debt, and then they syndicate out that debt. They call it M&A debt, merger acquisition debt. So they syndicate that out within 2 weeks. Now, because the market becomes dislocated and the bond yield jumps significantly, no investment bank wants to take a loss on it because they know they will sell it. It's just at this point, things are a bit unstable. So a lot of them just held that loan back, and they said, look, we'll syndicate that out later. But what that means is that, going forward, all the deals sort of has been put on hold. That's part of the actually big reason of why the debt didn't take place, the M&A couldn't take place. But my view is that by next year, while a lot of those excessive debt has worked through, the market will function again. And there's a lot of M&A deal will come through, and Ramsay is certainly top of mind for a lot of them.
And you mentioned the revenue hit that COVID caused Ramsay. There's also their cost base went up significantly. Running anything became a lot more challenging during COVID, particularly in the healthcare space. Do you think those costs can come down? And if so, when do you think they can start to rationalise the cost increases that COVID caused them?
Yeah, absolutely. So cost is a big issue, especially for private hospitals. Nurse difficult to come by. It was interesting to observe. So during the pandemic, there's been a lot of significant pressure on nursing staff, and we have seen a lot of people actually leaving the industry and not coming back to the nursing. Now, one of the big thing is that the border was closed for a very long period of time. And previously, we used to bring nurses in from overseas because we couldn't, and there was people leaving the industry. So there was significant pressure on finding people and then what you pay them. So that was a lot of costs that came through. But what we have seen, though, the government has actually been really, really quick in moving on to approve visas for work visas to bring people in. So we started seeing actually that side of things loosening up. And we do hope over, next 12 months or so, as the mobility improves, that cost will gradually get better. Now, for this business, because Ramsay is pretty much a fixed cost business, when revenue goes to zero, where they couldn't open for business, the cost is it's phenomenal. So for them, the earning will recover sharply just as the top line started coming back, and we know it will simply because the borders the hospital is open now. People can go to hospital, can do the elective surgery with a long waiting list. So that's almost guaranteed the revenue coming back. And so net, the profit will gradually getting better. Actually, gradually getting better this year, and then by next year, it should be up significantly.
And there was speculation that if KKR got Ramsay Healthcare, that they'd sell and lease back the property portfolio of hospitals. Do you think that's still a possibility? And what sort of capital could that free up if that was a path that Ramsay went down?
Sure. Yeah. So there's a $600 million of property, premium property that's sitting on the balance sheet. And for Ramsay, it's not a company that has actually consistently revalued their property on the way up. So, we all know what happened to the property price in the last few years. It got up 40-50% in just a few years. They have never really revalued all of that. So, this is the value that is sitting in Ramsay's structure, the sale and leaseback. We've seen other hospital group done it. We've seen, Healthscope. That's the other hospital, the second largest hospital chain. They've done it when private equity took it over. They split it up and they did all of that. It's absolutely workable structure. And Ramsay has talked to potentially they will review it. But as we know, Ramsay board is incredibly very very conservative. They don't really want to overvalue or overgear, because ultimately, if you sell or lease back, you put gearing into the business. It's a commitment that you have to pay. It's rental. So the board is very conservative. But if private equity takes over this business, absolutely, that's the first thing they will do, and that's premium asset. We can see a lot of interest in that portfolio.
And with about 27% of the Australian market that Ramsay hold, is it realistic that they can continue to grow through acquisition in Australia, or have they sort of reached saturation point where the ACCC would step in if they tried to grow too much locally from here?
Look, with Ramsay, I think the growth domestically will probably more through the brownfield, the greenfield. So the brownfield is the existing hospital. You expand a little bit and then make them better theatre, better equipment, and you attract more doctors. And then these brownfield normally generate your return on your capital is something like 18 months. It's very quick. It's very profitable, and they've been doing that for years. And the other one is greenfield. They have a few greenfield lined up, but that's not going to be huge growth driver. But over time, it's really just these two components to drive it instead of buying businesses. Just because the next big hospital chain is Healthscope. That's pretty much it. So it's really have to grow organically in this market. But don't forget, they don't really need to take grow or buy businesses to grow within the Australian market at this point. Volume is at all-time low. They've got all these waiting lists to work through. So the actual industry itself will grow phenomenally. And being the largest player in this market, quality player, that they have held on to their staff, they will recover in much better shape than any of other competitors.
And we know the Great Britain pound has been trading like the Mexican peso recently. They've already got a presence in the UK. Could you see them capitalising on their currency weakness over there in the UK and perhaps looking to expand in that market?
Look, there's a possibility, but my view is that the company is probably looking to to see the recovery of the core business, and within Australia, because we will recover in the next few years, so they will probably see that cash flow coming through before they start making a decision to buy more. As I said before, that the board is very conservative. They don't want to take on unnecessary risk, by gearing up the balance sheet a lot, because domestically business hasn't become fully cash flow, 100% cash flow pre-COVID. So they will be taking a very conservative approach, but absolutely, they're in many markets, and these markets represent a lot of value at the moment. And if any of those guys opportunity come up, remember they were trying to buy a business over there, and and it didn't quite come through. There is absolutely opportunity for them to do so, but I do think it will take some time for them to pull the trigger.
And so talk us through the numbers. What's the market cap? What do you think their PE will be at the end of FY23? And talk to me about their balance sheet and where that currently sits.
Yeah, the market cap is over $20 billion, so it is a big gorilla. In terms of the earnings for next year, the company, remember, this year we're still yet to recover to full pre-COVID level. We're still in that sort of start-stop level for elective surgery to gradually come back. So this year is over 23 times in terms of multiple, but by next year it's falling way below 20. It's on 18 times. So this is 2024, because that is the only first fair estimate of what the company normally earned before COVID. So on that basis, the company trading on very cheap valuation, hasn't been this cheap for many years. Especially when the earnings going to grow over the next 3 years. We expect the earnings to grow at 35%, sort of compounded EPS growth. That is incredibly strong.
That's awesome. Jun Bei, thanks very much for coming back on. Always great to chat to you.
Thank you so much for having me. It's great to chat.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.